Welcome to a tactical brief on Tesla, the investors, speculators and traders. Risk disclaimers are this time at the back of the clip, also a brief introduction in who I am. And now, do I have any material interest talking about Tesla? You bet I do. First of all, I think Elon Musk is one of the coolest dudes that there's out there in the industry. Why do I think that? Well, he's drilling tunnels into the desert. He's sending people to the moon or Mars eventually. When other people are talking about the financing of his company, he sells flamethrowers. And he sent David Einhorn, a well-known short seller, a pair of very short shorts to put his nose into his misery by being short Tesla stock. And I almost forgot, they make fantastic cars, and that's the other material interest. Of course, when I saw the Cybertruck, I had to order one. I hope they will come out soon. Where do you get something that looks like a Batmobile for roughly 70, 80,000 US dollars? It's fantastic. Having got that out of the way, I do not own any shares. I'm not long, I'm not short. So what I'm talking today about will give me some situational awareness because I'm not caught in any position at this time. So, what is going to happen with Tesla in the future? Nobody knows. Obviously, we all have our ideas about the company and there's a lot of research done, but we can't really see, especially in this market period after the March bloodshed we had in the market and this huge rise Tesla displayed over this time period since the beginning of the year specifically, how the fundamentals are going to change or what the analysts who are crunching the fundamentals are going to divine and hand out as recommendations. But we can look at the tactical situation at Tesla, and that's actually quite interesting at the moment. Tesla has an implied volatility of around 100 at the moment. What does that mean? There's a 2 in 3 chance that in a year's time we will probably not trade above 6,000 or below 340. Well, that doesn't give me too much information, obviously, if I want to put on a trade, but the volatility itself will give me an indication what might happen to the share price of Tesla if things are changing and volatility might normalize. Usually Tesla volatility used to be around 40, 45, in the peak 50, 55, then came down again. Now we are at double that level. What information can we get out of that? And to do this, I'll quickly take you back into the normal equity market, let's call it normal, and how the procedure of institutional managers, the smart money, usually is. Investors give their money and say, you pick the right equities, securities, whatever you like, and make me some money. Okay, they go out, they do their research, they pick a portfolio, and they have an idea about what they expect in performance. That's part of their model. So assume a stock is trading at 100 and they think, I believe this stock could go to 110. It's very unlikely that goes to 115 in the time period I'm looking at, but that's what I'm going to do. So how can they get additional income out of it? They sell a call option at 115. Why do they do that? First of all, if the stock increases to 115, they have the 15% performance already pocketed in. At 115, they will lose this stock to the buyer of the call option. So the buyer can then have this stock at 115, even if it trades above, or especially if it trades above. But for this sold call, they received a premium. If the market only goes to 110, 112, stays at 110, then they have received an additional premium by selling this call option. And they do this over and over and over again on pretty much every holding they have, because 90% of the market are generally long, 10% are short, probably even more to the 95. Generally, that's how markets work. People invest to hold shares, not to be short shares. On the downside, for their protection, they buy puts. They say the stock's trading at 100. I have a very good feeling about this. I did all my homework. However, it could drop. Then I want to have some protection, especially if there's a massive drop. The bottom falls out. You don't know why. It's still a good company, but markets are weird, and occasionally they are weird. So they want protection. They buy put options. So they're long a put option and they call a short call option. On the upside, the put option gives them protection. The call option gives them an additional income. For the put options, they have to pay. For the call options, they receive income. So where do they do these transactions? They do this at large institutions, at market makers on the derivatives side. So when I was still active, a salesperson came over and said, I have this customer XYZ, and he wants to sell call options let's stay with our example, at 115, and he wants to buy put options at 90. Will you make me a bid and an offer? So I, as a market maker, had to buy the call option, and I also had to sell the put option. And not only one guy is doing that, they're all doing it. They're all at it. So I get a lot of calls coming in my direction, and I have to buy them. What happens if there's a lot of supply? Prices go down. I will lower my prices. So volatility in these call options goes down. What's with the puts? Everybody wants these puts. So they all come to me. I have to sell these puts to them. There's a lot of demand suddenly in the puts. So I will increase my prices. Volatility goes up. Here already you have an explanation for the so-called skew of the options, which is generally lower on the call side and higher on the put side. Good. Volatility is at 100, and we are still in the Tesla world now. So we've seen the crash that happened on the equity market, and markets went down in an instant, and volatility in the VIX spiked to 80. Okay, we've seen that. So there's also a video of mine on this channel where I explain the relationship between volatility and performance. So we've seen a crash, volatility spiked, and when volatility came down again, markets recover and started climbing up again. Volatility has fallen again from 80 to 25 in the VIX, just to give you an idea. So there was a crash, and volatility did what it usually does in these cases. So how can we translate that to Tesla? Flip the chart. In Tesla, a crash happened, but the crash did not happen on the downside. It happened on the upside. Why? At the peak last year, mid-June, I think were the figures, almost 47% of Tesla shares had been shorted, which means the process, money managers looking for high quality stuff, was reversed. They were looking for really bad stuff and wanted to short bad stuff. So how do you hedge yourself against a position like that? You anticipated it? We reverse the positions. Yeah? They buy a call on the upside, because the worst for a short seller is, let's assume the stock is at 100. If it falls, you can only lose 100 if you're long, or you can make only 100 if you're short. That's the game. But if it doubles, triples, quadruples, you can lose 100, 200, 300, an infinite amount on your short investment. So their protection in this case is on the upside. They buy calls. Where do they buy them? So what do they do on the put side? They sell puts. They generate additional income. Think about it for a moment, what's happening there. They are short the underlying, right? And if you're short the put, you have to take the equity in. You sold the stock at 100, you're short the 90 put, you get the shares at 90 delivered, your short is filled, you're out again, you've made additional premium. Fine for you. So it's exactly the reverse position like we would have in a normal quality market. That was the game played in Tesla. And then usually things go wrong. Obviously all these shorties didn't expect that he would bring out a Cybertruck. That's when the market really started rallying. And you saw suddenly volatility on the upside increase. What we see on the equity markets, when the markets fall 20 to 30%. So volatility spiked in Tesla on the upside. Okay, fine. Now I, as a market maker, was sitting there, and I wasn't long the calls, I was short the calls. Okay, what do I have to do to hedge myself? As a market maker, I have opinions, but my job description is not to act on my opinions. My job description is to hedge the risks anticipated. And I do that by trading in the underlying against the option position I have. Bear with me, it sounds complicated, it is not. So I'm short the call, which means if market goes up, that hurts me. What am I going to do? I buy Tesla shares against it at a specific ratio. This specific ratio is also known as the delta. It tells me how much shares I have to buy to be delta neutral, which means if Tesla shares goes up, I will bleed on my calls. I'm short, but I will make money on the long holdings I have. Okay, so far so good. Let's look at the upside first. Then volatility rises. What happens when volatility rises? The hedge ratio, my delta, changes dramatically. When you hear usually the stock is at 100 and the strike price is at 100, you've heard that is a delta of 50, which means there's a probability of 50-50 that it could go up or down. If volatility explodes, this delta of 50, which is usually only to be found at the money, where the price is, over almost all strikes, comes in at 50 as well. So you have a volatility of 100, of 125, as we've seen in Tesla as well. Suddenly, not just the at-the-money call has a delta, a hedge ratio of 50%. Also, the strike price, which is 20, 30, 40% higher, is almost there at 50 because, well, if the volatility is that high, and I've told you about this huge spread we would anticipate earlier, you can do pretty much everything you want. Your hedge is 50-50. Yeah? I'm short the call, so I have to be long the underlying. Okay, that's the situation we are in right now. Market went up, shorties had to buy back. They hedged themselves by buying the calls and selling the puts. And I have the other side of this position as a market maker, and I have to hedge my position perfectly. Now volatility starts falling. So if volatility starts falling, does my underlying hedge in Tesla actually change? Do I have suddenly more or less shares in there? No, stays the same. There are no delta, gamma, theta, vegas, or there's a delta of course, that's one. But there are no delta, gamma, theta, vegas in general on the equity underlying. However, the call option I'm short, which had a delta of 50, a probability of 50-50. Stocks trading at 1600, I'm short the 1800 call, huge volatility, 50-50. Yeah? So for every share, for every call I sold, I had to buy half a share against it. So now volatility is falling, and that could be the tactical situation we see at Tesla at the moment, and that's when you know that you have to, at least for a time being, get out of this underlying or set up a short. If volatility is falling, the delta of the call is shrinking. The probability that you will still be at 1800 is falling from 50 to 40 to 30 to 20. What does that mean? I also have to start dissolving my hedge. You know, I was short the call and I was long the underlying, and I did that at a perfect ratio. Now volatility is falling. Now I have too much shares lying there. What am I going to do as a market maker? Even if I think Tesla is the best company in the world, I have to be hedged. I have to start selling equity. So we could see the bizarre situation, not really bizarre, just because we twisted it all around, that volatility is falling and Tesla will take a dive. How far this dive might go, I can't tell you now. You can look into the options position, the open interest, what is out there to get a good anticipation. That's something obviously I do as well when I look into these positions. However, falling volatility will lead to me as a market maker to start selling shares. If volatility falls further, I'll have to sell a little bit more shares. If you twist it around again to the equity market, that's exactly what's happening. Volatility is falling and equity market goes up because I have the mirror position here in Tesla. That's why things are a bit topsy-turvy in the Tesla world. So what's about the puts I mentioned earlier? Yes, I was long the puts, right? What am I doing in these puts? They are delta negative. So I have what? A long equity position against them. I also being forced to sell equity for this as well. You see the situation? Volatility comes down, and we are at a stage where a volatility of 125 peak in Tesla and now at 100 is not sustainable when there's a good company bringing out good products, which is being valued, I don't know, like a first-year company who has developed a medicine against baldness or the common flu. Volatility will decrease, and volatility in this case will lead to a decrease in share price simply because the tactics, the mechanical trading that forces the market makers will lead to this point. And this is called the Vanna. Second degree Greek. Don't worry about it, you can look it up. It simply describes what I just tried to do here, hopefully in a way that you could understand it, that a decrease in volatility has implications on my hedge ratio. And if volatility falls in the Tesla scenario, which is not the normal scenario, it's the vice versa scenario, will lead to falling volatility, to falling stocks, which is obviously not the case when you talk about normal equity markets. However, in Tesla we had this situation, and additionally, nothing related with options, the short interest ratio in Tesla from the peak of 46% or something like that came down to 6-7%, and even that is not sure whether that is really a short interest ratio or that has been derived out of convertible positions who are out there from Tesla. Simply another hedge, ignore that for the moment, just to let you know. Maybe we have now a scenario where Tesla enters the real world again and is being treated, after this decline in volatility is over, like a real normal stock with normal perspectives. However, knowing Mr. Musk from television and all his brilliant ideas, I would, in the long term, of course, bet on Tesla. I hope you enjoyed that little presentation. And if you have any questions, put them in the comments. And at a later video, I'll probably go in with a presentation again into the relationship between deltas, vegas, gammas, thetas, and vanas, and a couple of other things if you're interested in that. I wish you good success. Godspeed in trading, daring investors, traders, and speculators. Goodbye.